So you reckon you're a CMT brain box, now you're on level 2. Let's have it then. Picture this. You've got 100 grand in your account, the market's flying, everything's looking rosy, but you get that itchy feeling in the back of your head, that little voice telling you this can't last. How do you stop yourself getting absolutely wiped out by something that comes out of left field?
Mate, straight on it. I like it. That's the whole game, innit? You're talking about tail risk. It's that nasty little thing hiding in the shadows.
Right.
The tiny, tiny probability of a massive portfolio nuking event that no one, and I mean emphasis, no one, sees coming until it's too late.
Tail risks sounds a bit posh for a Tuesday morning. Break it down for the people at the back. Is that just a fancy way of saying black swan? We've all heard that one.
It's the engine behind the black swan. Think of a bell curve, yeah? Standard textbook stuff. Most days, the market moves a bit up, bit down, all clustered around the average in the middle of the bell. The tails are the absolute extremes, way out on the edges. The problem is, the academics tell you a massive crash, a 3 standard deviation event, is meant to happen like
Yeah?
once every 100 years or something ridiculous.
Which is a complete load of rubbish, and we all know it. We seem to get a once-in-a-generation crisis every 18 months these days. It's a joke.
Precisely. The bell curve is a lie. In the real world of markets, the tails are fat. The proper term is leptokurtic distribution, but all it means is that the crazy, impossible, market-melting events happen way, way more often than the models predict.
Okay.
That's your tail risk. The risk that one of those fat tail monsters jumps out and eats your entire portfolio for breakfast.
Right. So it's the monster under the bed that actually exists. So why is it so crucial to manage? Can't you just do the old diversification thing, buy a bit of gold, some bonds, job done, sorted?
That's the classic trap. That's what your granddad's financial advisor tells you. But in a proper tail event, think 2008 or the COVID crash in March 2020, what happens?
Go on.
Everything goes down the toilet at once. Correlations go to 1.
Wow.
Firmly, your safe haven assets, your defensive stocks, they all get hammered. Your diversification deserts you right when you need it the most.
So it's a portfolio killer, but on the flip side, it's massive opportunity for some, right? That's how the big short boys made their billions.
Exactly. One man's apocalypse is another man's payday. If you are positioned for it, a tail event can make you a legend. That's the whole game of tail risk hedging. You're placing a cold, calculated bet that a disaster is on the horizon.
Okay, so let's get into the nitty-gritty. How do you actually do it? What's the practical, street-smart way to hedge this stuff? Give me some of that CMT level 2 gold.
All right. The most direct, in-your-face way is to buy insurance. Simple as.
Right.
Just like you insure your gaff. In trading, that means buying put options. Specifically, you'd be looking at, long-dated, way out of the money puts on a major index like the S&P 500.
The classic hedge. But that's a constant cost, innit? You're just bleeding cash paying the premium on those options month after month, quarter after quarter. It feels like a total mugs game when the market is just screaming higher.
It's a massive psychological drain, mate. It's called negative carry, or what traders call bleeding premium. You pay, and 99% of the time, those options expire worthless and you feel like a proper idiot.
Yeah.
But that 1% of the time, when the world is ending and the market is in free fall, your puts can go up 10, 20, even 100 to 1. Suddenly, you're not an idiot. You're a genius.
It's the ultimate test of discipline. So that's the main strategy, just buy puts and pray for a crash. Seems a bit grim.
It is grim, but it's effective. That's the most famous way. A slightly different flavor is using the VIX, the fear index. When the market tanks, the VIX goes to the moon. So you can buy VIX call options. It's less a bet on the market going down and more a direct bet on panic and chaos.
Right, a chaos trade. But you know me, I was digging around. I read this paper from AQR, the massive quant fund. They were basically saying that constantly buying this insurance is a fool's errand long term. They were properly taking a mickey out of it.
Look at you doing your homework, chasing your own tail risk. Good paper. Their argument is solid.
Yeah?
Why keep paying an insurance company when you could just build a house that's less likely to burn down in the first place? It's about shifting from reactive hedging to proactive, intelligent portfolio construction.
Now you're talking. That's just common sense. So what's their master plan?
Well, first off, they say diversify by risk, not by money. Your classic 60-40 stock bond portfolio is a myth. In reality, it's more like 90-10 in terms of risk, because stocks are so much more volatile.
Okay.
You allocate capital to balance the actual risk from each asset. It stops you from having all your eggs in the equity risk basket.
So you're not just one bad week in the stock market away from being ruined. Makes sense. What's next in the toolkit?
Actively managing your volatility. It's dead simple in theory. When the market gets choppy and wild, when volatility spikes, you trim your positions, you reduce your exposure, you take risk off the table.
Right.
When everything's calm and quiet, you can add it back in. It's about tapping the brakes when you see storm clouds ahead, not flooring it into the hurricane.
So instead of being a buy-the-dip hero, you actually sell into the early chaos a little to protect your capital. I like that. It's a system. It takes the panicky human out of the equation.
100%. Then you add genuinely uncorrelated strategies. The best example is managed futures or trend following. These funds have systems that in a long, grinding crash will automatically start shorting the market. So while your long-only stocks are dying a slow death, this sleeve of your portfolio is actually thriving.
Love it. You've got a bit of your army fighting for the other side. The last one I saw in that paper was about low beta stocks, basically buying boring companies.
Pretty much. Building the equity part of your portfolio with solid, defensive, low volatility stocks. Your Nestle's, your Johnson & Johnson's,
Okay.
the big, boring giants. They won't double in a year, but they also won't get cut in half during a crash. They give your portfolio a steel backbone.
So the AQR philosophy is more about building an all-weather machine from the ground up, not just buying an umbrella every time it looks a bit grey.
You've nailed it. It's a complete toolkit. The direct hedges, the puts and the VIX calls, that's your fire extinguisher on the wall. It's there for an emergency.
Right.
But the AQR stuff, risk parity, vol control, defensive stocks, trend, that's your fireproof foundations and sprinkler system. A truly smart trader understands they need both.
But let's be honest, Morgan, at the end of the day, isn't the biggest risk just you? The emotional human clicking the mouse, the behavioral risk. I can just picture you, screen tans, sweating buckets when the red's flashing.
I'm not wrong. That's the final and maybe most important piece of the puzzle. Have a crisis plan before the crisis hits.
Okay.
Have a written down, systematic set of rules. If my portfolio drops by X, I will sell Y of my holdings. No debate, no emotion, no second guessing.
Right.
It's a circuit breaker for your own stupidity. It stops you from committing the ultimate sin, holding and hoping all the way down and then panic selling at the absolute bottom.
And then being too terrified to get back in and missing the entire V-shaped recovery. I've seen it happen to so many people. They get absolutely gutted, lose their nerve, and never recover.
It's the trader's life cycle of doom. So, long story short, tail risk is real. It's coming for you, and it happens more than you think. You can buy direct insurance with options, but that's a costly drag. The truly professional approach is to build a better, more robust portfolio from the very beginning, one that's naturally resilient to shocks.
Sorted. A proper no-fluff masterclass. All right, everyone listening, if you fancy getting in on more chats like this, roasting Morgan's latest crypto punt, or just having a laugh with a solid crew of traders, the link to our private chat group is down in the description. Hop in, it's a good vibe.
Hey, my trades are immaculate, thank you very much. But yeah, come and have a laugh with us.